Well, good afternoon, everyone. Welcome to today's webinar hosted by the M&A Advisor. We are delighted you can join us today. There's an ability for you to submit questions throughout the presentation by using the question box on your screen. Our panelists will answer as many as possible during today's interactive virtual session. And if you have any technical issues, you can contact us using this chat box as well, or simply hit help at the bottom of your screen. My name is Peter Kaufman. I'm president of the investment bank Gordian Group and head of our restructuring and distressed M&A practice. I lead our effort, which is focused solely on advising boards and private equity firms interested in shareholder recoveries in tough situations at the expense of creditors. I look forward to moderating a very engaging and interactive session this afternoon. We've got a great group of panelists. First, Liam Logue is the Executive VP of Global Corporate Development with UDG Healthcare PLC, which is a huge international pharmaceutical services business who's been very acquisitive. John Tishler is a partner with Waller Law in Nashville. His legal practice focuses on the representation of hospitals, healthcare systems, and healthcare companies in complex strategic transactions involving organizations facing financial difficulty. And John is really one of the leaders in the country in his practice field. Finally, Emily Johnson is a member with McDonald Hopkins in Cleveland. She focuses her practice on matters primarily for clients in the healthcare industry. She provides regulatory and compliance assistance on both the federal and state level, and she's assisted a variety of providers on regulatory, licensing, compliance, reimbursement, contractual, and corporate matters. She provides support to entities during licensure and accreditation surveys and in navigating state professional licensure laws, CLIA standards, and state and federal laboratory laws and regulations. All of the panelists' full bios are on the website, which you're able to easily access if you'd like to learn more. So with that, let me open up with the first question to the panel. How do you think COVID is impacting the marketplace we're talking about here?
Well, I think, Peter, that one of the strange things is, I think with all the money that has been pumped into the system in reaction to COVID, that you don't see as many distressed assets out on the market like you may have intuitively thought you would have seen.
Yeah, I can add to that. So my practice is primarily with respect to representing labs and pathology groups, which, as you can imagine right now, are extremely busy. And so there is a lot of money pumped back into the system at a federal and state level, but also just the reimbursement and revenue that's attributed to the number of testing my clients are doing. There is an extreme, I would say, uptick in their business right now, which makes them all the more profitable and more likely to acquire somebody that might be struggling.
Yeah, and similarly, I agree on both comments. We serve this industry, we serve pharma companies, so they are all having a reasonably good recession. So if any major trend I've seen over the last 6 months is that private equity money is being redirected from other sectors into healthcare and into pharma services in particular. It's not to say there isn't instances of distress. So like we would find, for example, across our business and our markets, areas such as meetings and congresses and congress management, which is normally an area where there's a lot of spending in the healthcare industry, has always been cut almost to zero, or certainly to a fraction of what it normally was. Areas such as clinical trial development have been severely disrupted. So undoubtedly there are distress situations out there, but they are pockets rather than something that you see as a blanket across the sector. So this is as an industry is having a good recession.
So let me switch gears. What regulatory concerns are there in a distressed deal on the buy side versus the sell side?
So I can take this first, since I am the healthcare regulatory person on the presentation around the panel today. So, I mean, it's always easier to be seller in these situations. There's less regulatory concerns to be worried about. From buyer's perspective, though, and sort of the unfortunate role that I play on these transactions sometimes is that even though you have a distressed seller who's trying to unload their practice, you're still constrained by the regulatory requirements, right? So you still have the biggest drivers are like licensure concerns and payer concerns. How are you acquiring those payer contracts, and how are you getting the licenses appropriately issued prior to the close of the deal, right? Because you need to be able to operate that practice effective as of the date of the closing. So those are the things that really drive it from a buyer's perspective, from a timing perspective. And then also from a buyer's perspective, just being aware of the skeletons that might hide in the closet, right? You know, the focus is often so much on the revenue and the business. And my job, my role in these deals is to remind folks of what inherent liabilities you are going to acquire as a result of this deal. What skeletons are in the closet, and what are you going to be responsible for once the deal closes? So it's having those things in mind.
Yeah, just to kind of further amplify some of that we see as sort of deal breakers sometimes are, if you're going to take over an operating healthcare facility, you're going to have to, unfortunately for the buyer, assume a lot of the contracts if the facility is going through a bankruptcy process. The liabilities under that contract are going to flow to the buyer, and sometimes those buyers, they don't get a lot of time to do due diligence. The process is often on a very expedited basis, and so you don't always know what you bought, to Emily's point, until it gets back to biting you, and then you don't have a counterparty to go after to satisfy some sort of indemnity right or something like that. So what we a lot of times build into some of our deals is we'll set up some escrows that will allow the buyer a little extra protection. But needless to say, tying up money in a bankruptcy case is not a popular thing with creditors.
Do regulatory concerns drive the timing of a deal? And if so, what's the effect there?
Certainly, I'll add in something in terms of timing and the comments that Emily made around licensing, which I think are very aptly made. We certainly had a concern back in the spring that licensing and getting through regulatory hoops would be longer, just given the disruption that's happened among all the various government agencies. Thankfully, that hasn't been the case. You know, we just found that most agencies seem to be fairly pragmatic, and we were able to get a lot of work done remotely that otherwise we would have thought would have been impossible. So it hasn't actually caused us that much of a concern around timing in that regard, although it's a very important consideration. A more challenging thing is any transaction we're looking at where we have to navigate through antitrust, because with just the market being so fluid at the minute and there's so many changes that are happening, I think it's quite difficult for any antitrust body to really determine what impact any transaction might have in terms of the competitive environment, medium term as opposed to short term. And I think because of all of that uncertainty, it may take longer for any antitrust body to make decisions in that regard. So that's one we're navigating a little more carefully, because clearly when you start a transaction that's got antitrust involved, it can be very disruptive. So certainly that's slowing us down in some things that we would otherwise be pursuing.
Thank you for that, all of you. Next question. What's the current status, in your view, of the market for distressed assets in healthcare, if you can generalize?
I think, you know, right now, where we sit today, there's not a lot going on. There's, you know, the retail side of the American economy seems to be pretty flush with a lot of distress going on. But again, because of the amount of money that has been pumped in the system, and as Emily noted, even in the reimbursement areas, how it's been pumped in, a lot of folks that you would normally see might be distressed, and they are probably experiencing distress because COVID has run off some of their more profitable options, like high-end surgeries are maybe getting postponed and not being done. So what you have are a lot of hidden distress by this money that's being pumped into the system. And so what I think is going to happen is once the tide goes out, it will expose a lot more of the distress that's really been there. It just was masked by the amount of money that was being pumped into the system to do the thing that everybody wants it to do, which is to help people get through the pandemic. But I think once the pandemic begins to recede, a lot of this distress may come to the fore.
Yeah.
Well, I have a couple observations I'd like to share. Recently saw Extant Medical do a debt restructuring where the creditors basically took over the equity. And so I'd extrapolate from that healthcare distress is experiencing a lot of what I'm seeing in other sectors, debt exchanges with creditors at the helm. I hasten to say, except where Gordian's advising the company, because we don't allow that to happen. But, I do see that there's going to be an increase in distressed M&A in the sector. It's going to be accompanied by the general woes of a distressed sale, meaning a startling low valuation. But right now, it feels like the creditors are content with taking over and avoiding the time and capital requirements and exposure to the market of a sale process, as they're generally getting a pretty good deal anyway. And I agree with Tish, makes a lot of sense through the lens of COVID, which does mask a lot of ills. And we think that there's even challenges today in marketing non-distressed healthcare assets. It feels to me and us, my partners, that the smart money in the space is tightening up more on venture-style healthcare deals to focus on what's safe and what they know works. But I do think that as the tide goes out, then you're going to see something.
Yeah, so thank you. I was just going to piggyback on to what John said with respect to the money that's been pumped into the businesses. In addition to the PPP loans that were available to a lot of small businesses, a lot of Medicare providers had this concept of provider relief funds that were available as well. And those funds, like the PPP funds, were money that was provided to providers who had billed Medicare within the last year. And the funds were intended to be used for a lot of the same things that the PPP funds are used for. The critical component there, though, is that you're supposed to specifically allocate how the funds were spent. And there is going to be in the next, several months as the funds dry up, but also the public health emergency period ends, there's going to be a lot of interesting financial situations impacting these recipients of the funds, because they will have to audit and attest to, one, how they spent the funds, and two, CMS has already actively stated and included language in the terms and conditions for receiving those provider relief funds, language surrounding fraud and abuse. So there's going to be audits, extensive audits, right, into how the money was spent. Was it done for reasonable purposes, or was it mishandled in some way? When you look at the terms and conditions language, there's penalty language that you can read in based on how they've drafted the terms and conditions. So you're talking now potential False Claims Act liability or some sort of multiplier damages associated with misappropriating those funds. I raise that, right, because if these providers get into trouble as a result of misallocating the funds, now we've got additional distressed concerns that will be on the market.
Thanks very much, Emily. For Liam and John, what's the prognosis for the acquisition of distressed healthcare assets for 2021 and beyond? What's your crystal ball say?
From maybe if I go first, I think I would agree that there are fewer distressed assets out there at the present moment, but I think they will likely increase in 2021 as stability comes to market. What we're seeing in particular is that there's going to be an increasing emphasis on transactions where cost savings and cost synergies are really at the center focus as a rationale for a deal. If you're looking over the last 2 to 3 years, pre-COVID, most of our emphasis for transactions were all around growth and how could we really turbocharge our growth as a company. But we're increasingly being approached by businesses that are more competitive with us, where the pitch really is we've got similar cost infrastructures. A lot of that is duplicated. Maybe if we were to do a transaction, we could save a lot of money together as part of that. So I think that will be more of a focus for some of the more distressed businesses for next year.
Yeah. And I think it sort of depends on what you're in the market for. Unfortunately, for I think the U.S., there's going to be a ton of rural hospitals that are going to be looking for buyers. The ones that have tried to go it alone, or they're in very small markets, they're maybe not even in a very big chain of hospitals. They may be by themselves. They're desperate. Their costs way outstrip what they're getting reimbursed by Medicare and Medicaid, and so there's going to be a ton of that. But I'm concerned that there's just not a market for that. And so what I think you have a market for are hospitals that are maybe in smallish chains, but are in urban areas that there's some desire by some of the larger, well-capitalized companies that would have an interest in them.
Yeah, and I think I would add on top of that, if I could, some healthcare verticals I'd be on the lookout for. End-of-life care, right? Nursing homes were ground zero for COVID, and a whole bunch of them are losing upwards of 90% of their patients to the virus. And Novell Pharma, we think that they're having a trouble raising private capital, and as these companies are generally pre-revenue, they really rely on the private markets to keep them afloat. And with timelines being stretched and the private investors not stepping up to the plate at this juncture, I think that's a vertical to watch as well. Let me throw this open to the three of you. In what way is the election playing into the market, if at all?
So I can take it.
Go ahead, Emily.
I don't know that there's a great answer to this. I think it's hard to attribute the election this year to any of the trends that we're seeing, just because there's so much else going on with COVID, with social issues, things like that. So from my perspective, I don't know that I can attribute anything to the election yet. I think what you'll see is post-election impact, right? Based on the outcome of the election, based on whether there's action with respect to like the Affordable Care Act in the healthcare space. But I'm curious as to John and Liam's thoughts as well.
So just to answer in terms of what we're seeing in election impact, in terms of healthcare specifically, we don't expect a lot, and it's perhaps because of the particular sector that we're in. We expect that regardless of who's in government, that existing drug prices will decline, and that a premium needs to be kept in place for new innovative medicines. And if that premium isn't in place, well then those medicines will not get invented as fast. And if anything, the PR for the pharmaceutical industry has improved over the last 6 months. I think more relevant, however, is taxes, and if it's likely that the tax on the gains on selling a business are going to increase, 2021 might be a year where you see a big increase in the number of companies for sale. Secondly, if corporation tax rates are going to increase, logically, that should say that valuations will come down, although it doesn't always happen that fast or happen as quick as logic might suggest. So that's our anticipation, at least, for what happens over the next few weeks.
Yeah, I agree with that with Liam. I think the other thing that we have found out is that there are two constituents that like the Affordable Care Act. Obviously, the American public tends to like having choices and that kind of thing, and being able to buy insurance with the pre-existing condition thing off the table. Everybody knows that. But I think the buyers of healthcare have historically liked it because they've gotten more of their typically uninsured premium or their uninsured patients covered. So if suddenly something happened with the Affordable Care Act, making a lot of the uninsured payments go away, I think you would also, kind of like the corporate tax rate going up, that may put a drag on some of the M&A transactions.
Well, riffing on all of that, any views about the pending Supreme Court case regarding ACA impacting the market?
Yeah, so I can start with that. So to piggyback on what John said, there will be, if the Affordable Care Act is repealed or replaced in some sort of manner, there will be a lot of uncertainty regarding some of those given payments. There was this requirement for insurance, so there was more covered services. The way payer policies were basically issued had been rewritten. So if we are to sort of revert back to pre-Affordable Care Act policies, that is going to create a extreme amount of uncertainty with respect to where is the money coming from, what does that reimbursement look like, and when will I receive it? So I think that will definitely have a very huge impact on the transactions that we're seeing.
Anybody else?
And I think I agree. I think any uncertainty of any type, tends to soften the M&A environment and see fewer transactions. So I think as we saw back in the first few months of the spring, a slowdown will occur. So I think it really comes down to when does the uncertainty wash through and when does that abide? But certainly I would agree that will have an impact.
Yeah, I personally think, and I've nothing to really back it up, that simply the election taking place and presumably with an acknowledged winner is going to take away some uncertainty. And I also think that the currently comprised Supreme Court is a bit of a tip off to where things might shake out with the ACA case. So I think we're starting to see just the passage of time is going to near term. I think we'll view the whole process with a little bit more certainty. Nature abhors a vacuum, so does politics and the M&A market. So who do we predict, what food groups do we predict are going to be the net winners in the next couple years in distressed healthcare?
Certainly the perspective that we're taking in relation to that is that despite it being a recession, within the healthcare space, there are some signs of bubble valuations. There's a lot of interest. There's a lot of private equity money coming in. So, we are conscious of the dangers of overpaying as well as just the distress that might be out in the market. So for us, it's really about maintaining discipline. The winners will be the ones that will maintain discipline. Clearly have to remain brave to go out and pursue things, but I think just staying disciplined is just the key thing for the next year or two.
I think the well-capitalized entities, of course, are going to be in a better spot to make acquisitive, investments at this point. I'm interested to see that some of the for-profit healthcare companies in the U.S. have drawn down on their lines of credit. I think they did that as a defensive measure when COVID first hit. I'm not sure that they've had to use up any of that dry powder, which may create dry powder for M&A transactions. Back to Liam's point, if the prices are right. That's been one of the bizarre things to me is I'm not seeing the values of healthcare assets drop. But I don't know, maybe Emily, you've seen something different there. I don't know.
No, I don't think so. I don't think I've seen anything different. I don't think the values dropped. I think it's figuring out what is the next new hot area, right? 10 years ago it was pathology. Recently it's derm. We're seeing a lot of ophthalmology. So I think is who's really financially in a great place right now to want to move forward with either consolidations and acquisitions of groups to build those super groups you hear about. And then on the flip side of that is who really struggled through this, right? So you might see more hospital consolidation of some of the specialty groups that were really, really hit by COVID. And maybe some of the other groups that have been made more stable will either try to form those super groups or continue on their own. So I think it's really identifying those market trends.
So let me give you a couple thoughts for people to react to. Again, in deals where Gordian's not advising the company, the winners here are going to be creditors who participate in the recap exchange offers because they're essentially getting undervalued equity as a result of a liquidity crisis that's at least somewhat not related to the company financial fundamentals, right? There's some overhang of COVID in all this. I think to the extent that their plays work out, the smart money, the hedge funds that have been scooping up strategic positions in the debt and equity of distressed firms, anticipating an exchange offer panning out. But if you believe the company's problems stem from COVID and not mismanagement or inefficiencies, recovery in value is likely in the long term if the companies can weather the storm for now. And then, of course, healthcare giants with strong balance sheets. I think those are going to be some winners. I think the competition is going to be thinner if there's a coming wave of insolvencies in the space, and they're going to be able to acquire distressed competition assets for pretty inexpensively to the extent that that's part of their business plans. Tish, you want to add anything?
Yeah, specific areas I've thought about is ambulatory surgery centers. That's been interesting to watch because they literally fell off a cliff in March. I mean, people were not going and having those surgeries. They seem to come back in the summer. I'm thinking they're going to probably slow down again. That's kind of the classic asset that may get some dings on it that would allow there to be some distressed buying. And so are there some, to your point, Peter, are there some like consolidators in the market who would want to just kind of roll up a whole bunch of those? This might be the time to do that because I've wondered, is private equity pumping in money into those ASC companies, or are they kind of getting a little skittish at this point, going, how much longer do we have to hold on to see the end of the light at the light at the end of the tunnel?
So I want to skip around a bit because I want to go back to a point that John Tishler raised earlier. I'm very interested in the rural markets. Is there anything to be done here? Is it too far gone? I'm going to have some thoughts to share after I hear if anybody wants to chime in first.
Peter, do you think if I heard you correctly, is about the world markets, the global markets?
Rural, I'm sorry.
Oh, rural, excuse me. No. Well, I'll pass that one to John and Emily, because we don't do much on the rural side.
Well, at the risk of sounding like a real downer, I'm very concerned about those markets. The competition has become in the last 20 years extreme for rural hospitals, let's say, for instance, because technology has advanced so far, but yet it is so expensive. And so for, some states, let's take a state like Mississippi, which has, 30 or 40, maybe 60, 70 rural hospitals in it, one every 30 miles or so down the road. For them to keep up with the technological and equipment advances, it's just impossible. And so they're already in a situation where they have to refer the sickest folks to the more, the larger centers in their state or other states. So how do they compete? And that's what I look at and wonder about. And then you put on top of that, how do they attract the best physicians? There are some very innovative things being done in med schools about deferring or forgiving tuition and that sort of thing, but I just don't know that there's enough of that to be done in order to save the vast majority of these hospitals. I think, and like I said, I hate to be depressing about that, but it's somewhat a Darwinian thing.
Yeah, my bottom line is that the way to play rural might be to look into, I'll call them the mid-sized Midwestern rural places, St. Louis, the Twin Cities, Des Moines, because you can make a case, as Tish just has, and I could make other cases along the same lines, that it's probably not worth investing in healthcare in these communities. On the other hand, when the farmers go bankrupt and end up having to work for the corporations that bought their assets out of bankruptcies, those corporations do have healthcare insurance as part of a payroll, and so there may be some money flowing in that way. So this is an area where I'm firmly of two minds, but I do think it's of great interest, and I think that where there's uncertainty, there are going to be people who make a lot of money. Emily, any observation?
I don't think so, not really. I mean, I have regulatory concerns associated with some of the things I see in the rural markets, which have impacted deals. Some contractual arrangements that you're seeing. We saw this years ago in the toxicology industry. Tox groups would target rural hospitals because they had way more favorable reimbursement rates. So then they'd enter into some type of fraudulent contract or allegedly fraudulent contract for provision of services that never even went through the hospital, but were billed through the hospital payer contracts. And it was just a really bad situation. I am now starting to see that same type of thing in other specialties where groups are trying to take advantage of the more favorable reimbursement rates through a rural health center or rural hospital. So it's not just unique to the lab industry now. So I think as we start thinking about buying and selling rural hospitals on the diligence end, right, that stuff is one of the skeletons in the closet that we talked about at the beginning, just to be aware of, because there is a lot of scrutiny regarding those rates because they are so good.
And I think one of the things that's a saving grace here is while keeping a hospital in every small town in America may be difficult to do, telehealth has really come to the fore through this pandemic and shown, I think, a way of the future for a lot of these smaller towns, and you don't have to lose your health care in the small town just because you don't have an acute care hospital in the town. You can have the doctors and the various people that are working there in the small town help provide quality health care for people in that small town through telehealth or other unique ways, a clinic, an ambulatory kind of role for like a freestanding ED with an, Pelipad on it or something like that. Those kinds of things could really, I think, transform some of these rural areas if they could see their way to maybe realize that a full freestanding 50-bed hospital is not in their future.
I couldn't agree more. I think that there's a lot of innovative things that can be done, and I think it will be. I think that your iPhone is going to be a huge provider of, the initial stance on your healthcare. And I think that there's going to be an awful lot of retail spaces that are going to be able to be rezoned, reused for, the ambulatory stuff, those different things that Tish was just talking about. So I think that, again, I think no matter what happens, there's going to be change. And with change and dislocation comes opportunities. So I think rural, Liam, you should be thinking about rural opportunities.
No, well, perhaps, we are based in some beautiful rural areas. We're in the Berkshires in Massachusetts, but I think in every case, always our clients are always global. So we're all for rural, but we just have to diversify our customer base. That's all.
All right. My last question for this group is, who are the most likely buyers of assets? Competitors, opportunistic investors, private equity, folks like Liam, under-leveraged strategics, who, talk to us about that.
Yeah, well, certainly in what I'm experiencing now at the moment is that private equity is by far the biggest competitor. And what I think is happening is that private equity is finding that a lot of other sectors right now are uninvestable and hence are turning their capital towards the more buoyant sectors, namely healthcare and tech. So we're finding that in transactions that we're losing out on 3 times out of 4 is to a private equity investor. So there's a lot of money out there. And of course, debt is very cheap. We see the benefits of quantitative easing. I think at least for the next year or two, private equity is going to be our biggest competitor for assets. So that's where I see most activity.
Yeah, I would agree with that. I think probably in second place to private equity would be some, the competitors. You're going to have some consolidation in these industries, possibly with the stronger, well-capitalized groups coming in and rolling up and buying some of the smaller more, key to their geographic or other strategic plan. I think you can see some of that happening as well. But it's going to be hard, to Liam's point, to compete. Money is so cheap right now, and there's really no end in sight to that. So I think you will see a lot of private equity buying in this in this industry.
I don't really have much else to add to that. I agree with both of those points. So.
Well, first of all, I want to thank the M&A advisor for putting on this panel, giving me the opportunity to participate. And I really want to thank our panelists, Emily, Liam, and John Tishler, very much. I think this has been a great discussion. So thank all of you. I think it's time now to encourage the audience to submit questions. Again, you've got the chat box. We're here to answer questions to the extent we can. So please go ahead and do that. And after that, our work here will be done. So thanks all of you.
I think, are we waiting for Peter to join to host?
Yeah, I think he might be having some difficulty connecting. I do have a couple questions that came in that I'm aware of. So if you want, I could kind of step in for Peter until he's able to join, if that works for both of you.
Sure.
Thank you.
So the first question that I received is, what should the board of directors of a healthcare company be doing at this time?
Sean, do you want to go ahead first?
Okay. Yeah, go ahead, Liam.
Yeah, well, look, I'll tell you what we're doing at the present time. We're scenario planning for different lockdowns. So we're trying to determine country by country what happens if a lockdown is 1 month, 2 months, 3 months, and so on. And what does that mean in terms of how we preserve our business and how we protect our businesses, and what actions we have to do to hold costs down and potentially deal with liquidity issues. I mean, the one difference we have now compared to the spring when we had the initial lockdowns is when in the spring, I would have to say we weren't particularly well prepared, and most of our work was around defense. I think next time around, we will also be thinking around offense, as well as preserving our own business. Just create opportunities to invest in other companies where we can achieve cost savings more readily. So I would like to believe we'll be more ready for whatever may come next time around, albeit we're really hoping that there are no lockdowns at all, if at all possible. But certainly that's what we're doing at the present time.
Yeah, I would, I'd echo a lot of that. I think essentially sort of strategic planning would be that would be a good thing to do right now, is that kind of deep dive into the metrics of what the business is seeing and trying to project a little bit of what the business thinks it can do. I think everybody's hoping that there is some alleviation of the pandemic in 2021. So we may not be completely back to normal, but we could also be at a point where we could take advantage of opportunities, like Liam said. Or the flip side of it is, if the pandemic has dealt a company a significant blow, it may be time to think about, repositioning yourself to go through some sort of restructuring, maybe bringing in strong third-party help in the form of investment bankers or financial advisors to help project and get a sense of what the future may hold, and then make some decisions based on that.
So the next question is, when should the board of a distressed or potentially distressed company take some sort of action? I'm happy to take a first swag at that. Directors in an environment like this need to maintain options and optionality, and they only do that by getting out ahead of potential capital structure or liquidity issues and not hoping that things are going to take a different turn. So when you're, it looks like you'll be running out of money in 6 months, you should view that you're out of money now. You shouldn't wait. You shouldn't wait to go off the cliff with your creditors on covenant defaults. And you need to have look at your situation with a realistic eye and, bring on people who can advise you about what to do, because the passage of time is likely not to be kind to you if you look like you're having or will be having some issues.
I'd certainly agree with that. I think that the most appropriate thing to do is act early. Plan, you will hope for the best, but plan for the worst, and certainly there are a variety of businesses that are reaching out to us, just knowing that there could be difficulties in the months ahead, just giving us a steer that if that were to happen, they're looking at their options, and, we're very much happy to have discussions with those companies as to being even a reserve option for them, be it their plan B or their plan C.
So the next question, I think, is for Emily. What regulatory information will a seller need to gather in advance of a sale?
Yeah, so it's going to be pretty consistent with what you would gather in any acquisition or transaction. Run loss reports, revenue reports, payer contracts. Like I said at the beginning, payer contracts and licensure are what are going to drive the timing of a deal. So getting in front of those payer contracts and getting them to, if your buyer getting a hold of those contracts, or if your seller getting them to the buyer so you can understand what the timing is. Copies of the licensure, employment contracts, so that you can figure out is the employment contracts, or are the employment contracts that currently exist structured in a manner that complies with Stark and Annie kickback, or are there post-close obligations that you'd have to change to make them come into compliance? Any survey results from licensure surveys, accreditation surveys, things like that. Any deficiency reports, and then of course policies and procedures, because that you can look at the financials all day. But when you're trying to be concerned or aware of what those liabilities might be post-close, one real good way to get an understanding of that is by looking at policies and procedures and seeing how the business is actually operated on a day-to-day basis. And then, of course, if there was any history of overpayments or audit requests from a payer, you're going to have to be transparent about those as well.
I agree with all of that, and I'd actually add that there's often a danger that in an average transaction, we put a lot of that compliance and regulatory diligence to the middle of the process or even towards the end. I think in distress situations, it needs to be moved up front, so that no time is lost in getting the deal done.
I agree.
Well, I think that is all the questions that have been asked. And I think we're running out of time anyway. I want to thank all of our attendees for joining us today. We look forward to seeing you at the next webinar hosted by the M&A advisor. And thank you very much to our august panelists. And we all appreciate the chance to visit with you today.
Thank you.
Thanks.
Thank you.